Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about 3 Million Co. quarterly report. The 3 Million Company provides a wide range of diversified technology services across various industries. The company's three main segments include safety and industrial. Offers products such as industrial abrasives, personal hygiene products, electrical materials, structural adhesives, and respiratory protection solutions. Transportation and electronics. Provides ceramic solutions, attachment/bonding films, light management films, chip packaging, semiconductor production materials, and data center solutions. Consumer. Offers cleaning products, consumer air quality products, picture hanging accessories, retail abrasives, stationery, automotive appearance products, and consumer bandages. The company's products are sold through various channels, including e-commerce, traditional wholesalers, retailers, jobbers, distributors, dealers, and directly to users. The significant increase in 3 Million Co.'s stock price over the past year can be attributed to several key developments. The company's strong Q3 2025 earnings, which exceeded Wall Street estimates, led to an upward revision of its full-year profit forecast. Additionally, strategic initiatives aimed at boosting innovation and operational efficiency, as well as a commitment to returning cash to shareholders, have contributed to increased investor confidence. The anticipation of new product introductions and operational improvements has also driven the stock price upwards. Furthermore, the completion of the spin-off of 3 Million's healthcare business in April 2024 was seen as a strategic move that could have been viewed favorably by investors. These factors collectively demonstrate that 3 Million's efforts to revamp its operations and focus on innovation have paid off, leading to a substantial increase in its stock price over the past year. The primary drivers of revenue growth for 3 Million are strong demand for its products, new product launches, service improvements, and increased investment in advertising and merchandising. Conversely, the company's revenue decline is driven by soft consumer discretionary spending, cost dyssynergies from exiting PFAS manufacturing, decrease in PFAS-related environmental liabilities, and purchases of treasury stock. These factors are influenced by external conditions such as global economy downturns, geopolitical tensions, foreign currency exchange rates, climate change, and changes in local economic conditions. Additionally, operational challenges like workforce restructuring, adapting to business model changes, and customer service issues can impact revenue growth or decline. To mitigate these risks, 3 Million must focus on operational execution, productivity improvements, and compliance with laws and regulations. By addressing these drivers of revenue growth and decline, the company can navigate its market and achieve long-term success. Net income and profit margins. A decline amidst global uncertainty, the financial performance of a company has taken a hit, with net income decreasing by $538 million in the 3 months ended September 30, 2025, compared to 2024. This decline is even more pronounced when looking at the 9-month period, where net income decreased by $772 million. Profit margins have also suffered, with operating income margin decreasing by 1.3% for the 3 months and 0.3% for the 9 months. The effective tax rate has increased from 20.3% in 2024 to 26.8% in Q3 2025 and 23.7% in 9 Million 2025. The reasons behind this decline are multifaceted, including global economic downturns, geopolitical tensions, climate change, foreign currency exchange rate fluctuations, increased production costs, supply chain disruptions, limited access to end markets, and uncertainty related to planning long-term investments and strategies. These factors have cumulatively contributed to the decline in net income and profit margins, making it challenging for the company to maintain its financial stability amidst a turbulent global landscape. The company is generating a significant amount of positive operating cash flow, indicating a strong financial position. In 2025, net cash provided by operating activities reached $723 million, a substantial increase from $1 million in 2024. Furthermore, operating cash flows increased by $0.7 billion in the first 9 months of 2025 compared to the same period last year. This trend suggests that the company is efficiently managing its operations and generating sufficient cash to support its growth. The company's debt level and interest expenses have undergone significant changes. Notably, long-term debt has increased by $729 million, reaching $10,844 billion as of September 30, 2025. This is a notable increase from the previous year's total long-term debt of $9,856 billion. However, the company's total debt actually decreased by $1.8 billion during this period. In terms of interest expenses, there has been an increase of $100 million for the 9 months ended September 2025 compared to the same period in 2024. This rise is likely due to a surge in interest rates, which may continue to impact the company's financials. The company's financial performance varied across different segments and regions. Notably, the safety segment stood out as one of the top performers, while the industrial and electronics and energy segments also saw significant growth, with revenue increases of 7% and 5%, respectively. On the other hand, the healthcare segment experienced a decline in revenue by 12%. The transportation and electronics segment, as well as the consumer segment, also underperformed, with decreases in both 3-month and 9-month periods compared to the previous year. Management is optimistic about the company's outlook, expecting growth and productivity outside of special items. The company will continue to invest in growth initiatives, including new product launches, service improvements, and increased advertising and merchandising. Key areas of focus include organic sales change, respiratory protection products, and the exit of PFAS manufacturing by 2025. With a strong balance sheet and liquidity, management is confident in its ability to fund opportunities and drive demand through strategic investments. The acquisitions and divestitures of a company can significantly impact its financial performance and strategic direction. In this context, the company has made several notable transactions. Acquisitions include Yarrow Holding Corp., parent of Yarrow Technologies, acquired by a subsidiary in April 2000, and 8 derivatives with a fair value of $145 million. As of September 2025, divestitures include the spin-off of the healthcare business to form Solventum in April 2024, sale or disposal of facilities in Salem County and Middlesex County, New Jersey separation of healthcare business through a pro-rata distribution of shares to stockholders in April 2024. These transactions demonstrate the company's efforts to restructure its operations and focus on core businesses. The company has a long history of rewarding shareholders through dividend payments and share buybacks. In 2025, it paid out $1.175 billion in dividends, with quarterly payouts totaling $0.73 per share. Additionally, the company repurchased $2.7 billion worth of its own stock within the first 9 months of that year. This demonstrates a commitment to returning value to shareholders through both dividend payments and strategic share buybacks. Concerns about inventory buildup and supply chain disruption are mounting. The company's total inventories have increased by $195 million on page 5 and a further $205 million from December 31, 2024 to September 30, 2025 on page 67. Changes in customer order patterns may also contribute to inventory buildup. Supply chain disruptions are another pressing concern. The company is evaluating third-party products that do not contain PFAS, indicating potential supply chain disruptions, page 28. Geopolitical tensions, cyberattacks, and climate change pose further risks to the supply chain, as do severe weather events and supplier relationships being interrupted or terminated. That concludes the financial summary for 3 Million Co. Feel free to comment below, and I will be happy to answer them when possible.